Warren Buffett is the only person who, from scratch, built a company that is in the top 10 of the Fortune 500.
I was always playing around with numbers. I find it enjoyable.
$100,000, one ETF ticker, the S&P 500 less than 1% below an all-time high, the most psychologically punishing entry condition in personal finance, and the one Warren Buffett, in every shareholder letter for 2 decades, has told ordinary investors to ignore. In May 2026, the S&P 500 is breaking past 7,352 intraday. VOO trades at $665.30. $100,000 buys 150.3 shares. Here is the question that paralyzes nearly every retail investor. Deploy the lump sum today or wait. I will walk you through the historical data, Buffett's positioning, the 4 return scenarios, and the 5 deployment options. By the end, you will know what the math says, what Buffett is doing with his own capital, and where the real risk lives. VOO launched September 2010 with an expense ratio of 0.03%. $30 a year on a $100,000 position. Fund assets eclipsed $1.42 trillion in 2026. Tracking error typically below 0.05%. The dividend yield runs 1.07 to 1.13%, roughly $1,100 annual income on $100,000. That suppressed yield reflects share prices expanding faster than dividend payouts, driven by the technology conglomerates inside the index. The Magnificent Seven, Nvidia, Apple, Microsoft, Amazon, Alphabet, Meta, and Tesla, now constitute between 33.7% and 34.78% of the fund. A $100,000 VOO investment allocates nearly $35,000 to 7 megacaps. The diversification argument has fundamentally changed. Now, to the headline question, should you deploy at an all-time high? Since 1952, the S&P 500 has closed at an all-time high on roughly 6.8 to 7% of all trading days. It has spent about 12% of its history within 1% of a record high. From 1988 to 2024, an investment made on a day the S&P closed at an all-time high was profitable 1 year later. 88% of the time, average return 14.6%, higher than the 83% rate and 11.7% for random entries. Roughly 30% of all-time highs become permanent market floors, but averages conceal devastating case studies. For examples, the 1987 all-time high. Investors deployed at the August peak and walked into Black Monday on October 19th, a 20.47% single-day loss. Recovery took only 19 months. The 2000 all-time high, the dot-com peak. The crash wiped out 49.1% of the index. Factoring in the 2008 collapse, it took 13 years for a lump sum invested at the March 2000 peak to break even nominally. Adjusted for inflation, longer. The 2007 all-time high. Capital deployed at the October peak suffered a 56.8% drawdown during the global financial crisis. 65 months to recover. The 2021 all-time high. A 25.4% drawdown during the Fed rate hike cycle. Recovery by January 2024 thanks to the AI infrastructure boom. ATH investing works, but only if you have the capital structure and psychological fortitude to withstand multi-year, sometimes decade-long periods of stagnation when valuations revert. Now, why this all-time high may be different. The Buffett Indicator. Total U.S. stock market cap to U.S. GDP. As of May 2026, that ratio sits at 228%, 2.4 standard deviations above its historical trend. Buffett's December 2001 Fortune essay, written before the dot-com collapse, if the percentage relationship falls to the 70 or 80% area, buying stocks is likely to work very well for you. If the ratio approaches 200%, as it did in 1999 and a part of 2000, you are playing with fire. We are not at 200. We are at 228. 28 percentage points above Buffett's explicit danger threshold, in a realm devoid of historical precedent. The Shiller-Cape ratio sits between 36.48 and 40.24, only the second time in 155 years that this metric has sustained levels near or above 40. The first was the 1999 technology mania. Institutional bear forecasts are severe. Goldman strategist David Kostin recently forecast 3% nominal annualized for the S&P over the next decade, the 7th percentile of 10-year returns since 1930. GMO's 7-year forecast, updated in early 2026, projects negative 2.7% real for U.S. large cap. Hussman's models project 10 to 12-year returns below Treasury yields. Guru Focus regression models project negative 0.7% annualized over the next 8 years. Now look at what 100,000 compounds to across all 4 scenarios over 30 years. Scenario A, the bull case, 10% annualized, the historical S&P average. Year 10, 259,000. Year 20, 672,000. Year 30, 1,744,000. Scenario B, the base case, 7% annualized, modest multiple compression. Year 10, 196,000. Year 20, 386,000. Year 30, 761,000. Scenario C, the Goldman-Costin case, 3% nominal. Year 10, 134,000. Year 20, 180,000. Year 30, 242,000. Scenario D, the GMO bear case, 0% nominal, negative 2.7% real. Year 30, approximately $100,000 in nominal terms, deeply impaired in real purchasing power. The divergence between scenario A and D is $1.7 million. Same starting capital, same 30 years. This is the actual range mid-2026 institutional analysis says is possible. So how do you deploy? The Vanguard 2012 study analyzed US, UK, and Australia data. Lump sum investing outperformed DCA roughly 67% of the time over 10 years. For a pure equity portfolio, lump sum returns ran 2.4% higher than DCA over a 12-month implementation. Equity markets exhibit upward drift, positive returns in 70 to 75% of rolling 12-month periods. But below the 25th percentile, DCA materially outperforms. If you deploy 100,000 and the S&P contracts 30%, your portfolio shrinks to 70,000. If you DCA at 8,333 a month, you buy progressively cheaper shares. Mathematically, lump sum wins. Behaviorally, DCA is insurance against buying the top and panic selling the bottom. Buffett himself prefers retail investors continuously DCA into index funds. If Buffett endorses DCA into VOO, what is he doing now? Q1 2026. Berkshire Hathaway holds $397.4 billion in cash and short-term treasury bills, the largest cash hoard in company history. Berkshire has been a net seller of equities for 14 consecutive quarters. In Q1 alone, it liquidated $24.1 billion while purchasing only $15.9 billion. New CEO Greg Abel maintains Buffett's framework, refusing to deploy at valuations lacking a margin of safety. The greatest capital allocation engine in history is looking at a 228% Buffett Indicator and hoarding short-term T-bills. The resolution is scale. Berkshire operates with a nearly $1 trillion market cap. It cannot generate alpha buying small, undervalued equities. It must hunt elephants. Multi-billion-dollar acquisitions, impossible at 21 times forward earnings. A retail investor deploying 100,000 into VOO does not face these constraints. The retail investor has diversification across 500 companies and a multi-decade horizon. Now the test that determines everything. Can you actually hold through a 50% drawdown? The math only works if you stay invested. The historical drawdowns. The 1973 to 1974 stagflation, negative 48.2%, recovery 5.5 years. The 2000 to 2002 tech bubble, negative 49.1%, recovery interrupted by 2008, total recovery 13 years. The 2007 to 2009 financial crisis, negative 56.8%, recovery 65 months. The 2020 pandemic, negative 33.9%, recovery 5 months. The 2022 inflation shock, negative 25.4%, recovery 24 months. If the S&P undergoes a 50% reversion to correct the 228% Buffett Indicator, your 100,000 VOO position shows as 50,000 on screen. Will you hold or liquidate in terror? Dalbar's 2024 Quantitative Analysis of Investor Behavior says you probably will not. The S&P returned 25.02%. The average equity investor captured 16.54%, an 8.48 percentage point gap, generated by panic selling near bottoms and euphoric buying near tops. Buffett, volatility caused by money managers who speculate irrationally will offer the true investor more chance to make intelligent investment moves. He can be hurt by such volatility only if he is forced, by either financial or psychological pressures, to sell at untoward times. Enduring 50% drawdowns without capitulating is the price of admission for long-term equity premiums. Here are the 5 tactical options for a $100,000 deployment at this all-time high. Option 1. Lump Sum VOO, the mathematical favorite. In the bull and base scenarios, this captures maximum upside. In the GMO bear scenario, it exposes you to immediate capital destruction if multiples compress. Option 2. 12-month DCA at roughly $8,333 a month. The behavioral safeguard sacrifices about 2.4% in upside, but protects from absorbing a 20 to 30% shock on day 1. Option 3. The 50-50 split. Deploy $50,000 immediately. Hold the remaining $50,000 in T-bills, deploying at $4,166 a month over 12 months. Satisfies the math of upward drift and the psychology of downside protection. Option 4. Wait for a 10 to 15% pullback. The market timing trap. Historical data condemns this. Investors hold cash waiting for a drop and watch the market rally 40% before crashing 20, a net loss versus immediate entry. Option 5. Diversification. VOO plus international plus fixed income. Given the 34.7% Magnificent 7 concentration, shifting capital to international or bonds mitigates U.S. multiple compression. This aligns with GMO's thesis that emerging markets offer superior real returns. Who else is buying at this peak? The bears are defensive, Berkshire as discussed. Howard Marks of Oaktree emphasizes the negative art of investing. Jim Chanos has reactivated his bearish thesis on AI capex. Michael Burry exited Scion after taking asymmetric puts on Nvidia and Palantir. The momentum buyers are still long. Stanley Druckenmiller's Duquesne family office, while trimming Mag 7, has rotated international, with over $113 million in the iShares MSCI Brazil ETF T. Rowe Price and Norges Bank accumulate on the thesis that AI productivity will justify the multiples. The smart money is fragmented. That alone tells you this is not consensus. Here is your 3-step takeaway. First, a TH investing has historically outperformed random entry over 1, 3, and 5-year horizons. The fear of buying at the peak is statistically wrong, but the Buffett Indicator at 228%, 28 points above his danger threshold, has no precedent. Both can be true. Average history endorses deployment. The 2026 valuation regime warns against it. Second, which scenario are you structuring for? If you believe the bull case, lump sum is optimal. If you believe the GMO or Goldman bear case, no deployment at this valuation is rational, you wait or diversify. The 50-50 split is the honest answer for most investors. They do not know which scenario plays out, and they need behavioral insurance. Third, stress test your psychology. Imagine your $100,000 on screen at $50,000 for 5.5 years, like the 1973 to 1974 investors, for 13 years, like the 2000 investors. If that causes you to consider selling, you are not the candidate for lump sum. You are the candidate for DCA. If you want to know which vehicles match VOO's tracking, which Roth IRA structure shields the growth, and which behavioral guardrails long-term holders used, that information is widely published. The Vanguard 2012 study, the Dalbar QAIB reports, Berkshire's annual letters, Damodaran's dataset at NYU Stern. The math is not hidden. The discipline is rare. I am not a financial advisor. This video is educational only, not personalized financial, tax, or investment advice. Past performance does not guarantee future results. All investments carry risk of permanent capital loss. Consult a qualified professional for your specific situation.